Wall Street has sold you a story, a comforting, reasonable, and utterly misleading story. It's the story of the basket and the eggs. Don't put all your eggs in one basket, they chirped from the mahogany desks of their skyscrapers. Spread them out, diversify, buy a little bit of everything, and you'll be safe. It is the financial equivalent of a participation trophy, a strategy designed not to win, but to ensure you don't lose too badly. It is a protection against ignorance. But in protecting you from ignorance, it chains you to mediocrity. It guarantees that you will never, ever build transformative wealth. Because the great fortunes of this world, the empires of capital built by the true masters of the game, were not built on timidity. They were built on the polar opposite. They were built on courage, on conviction, and on the brutal, focused power of extreme concentration. And no one in human history has understood or practiced this principle better than Warren Buffett. He gave us a mental model so simple, so profound, that it slices through decades of flawed academic theory like a razor blade. He called it the 20-slot punch card. Imagine, he would say, that when you are born you are given a punch card with only 20 slots on it. And those 20 slots represent the total number of investments you are allowed to make in your entire lifetime. Every time you allocate capital to a new idea, you punch a hole. Once you've punched all 20, you're done. You can't make any more. Think about what that does to your decision-making. The frantic, day-to-day noise of the market evaporates. The hot tips from your brother-in-law, the speculative gambles, the fear of missing out on the latest trend, all of it becomes meaningless static. Your standards don't just rise, they skyrocket into the stratosphere. Each punch becomes a monumental decision, worthy of months, perhaps years, of obsessive research and deep thought. You stop being a speculator, a gambler flipping symbols on a screen, and you become an owner. You don't get paid for activity, you get paid for being right, and for being right in a very big way. This isn't just an investment strategy. It is a philosophy for life, a forcing function for discipline, and the one true path for the serious investor or entrepreneur who is tired of average returns and ready to play the game of capital allocation at the highest possible level. Today we are going to deconstruct this masterpiece of a mental model. We are not just going to talk about it, we are going to install it into your operating system. This is the masterclass in absolute conviction. We begin with the core philosophy, the very bedrock upon which this entire system is built. It is the philosophy of scarcity, and the punch card is its ultimate enforcer. To understand its power, we have to travel back in time, not to a boardroom at Berkshire Hathaway, but to a lecture hall filled with the best and brightest minds of the next generation of finance. Warren Buffett would often visit business schools, places like Columbia or Stanford, where the gospel of modern portfolio theory was preached as infallible doctrine. The students were being meticulously trained in the art of diversification, taught complex mathematical formulas to optimize portfolios with dozens, even hundreds of positions. They were taught that risk was volatility, and the only way to reduce it was to spread your bets as widely as possible. And into this cathedral of conventional wisdom, Buffett would walk, with his folksy charm and his disarmingly simple analogy. He would stand before these aspiring titans of finance and say, "I could improve your ultimate financial welfare by giving you a ticket with only 20 slots in it so that you had 20 punches, representing all the investments that you got to make in a lifetime. And once you'd punched through the card, you couldn't make any more investments at all." You can imagine the scene, a quiet confusion rippling through the auditorium. This man, this living legend whose name was synonymous with staggering wealth, was advocating the exact opposite of what their esteemed professors and their $1,000 textbooks had been teaching them. He was telling them that the very foundation of their financial education was, in essence, a mistake. He would go on to explain that, with this rule, you'd really have to think carefully about what you did, and you'd be forced to load up on what you'd really thought about, so you'd do much better. He wasn't just offering a cute piece of financial advice. He was launching a direct assault on the entire intellectual framework of Wall Street. He was saying that the system that produces legions of wealth managers and financial advisors was built on a premise that serves the industry, which profits from activity and complexity, but not the individual investor, who profits from simplicity and conviction. He was replacing their complex equations with a simple, physical constraint. The punch card acts as a forcing function. It introduces an artificial scarcity into a world of seemingly infinite choice. Every day, an investor is bombarded with thousands of publicly traded companies, endless headlines, and a cacophony of expert opinions. This abundance of options doesn't lead to better decisions. It leads to decision paralysis and shallow analysis. The punch card cuts through all of that. It tells your brain that opportunities are not cheap and plentiful. They are rare and precious. This single constraint changes everything. The casual, let's take a flyer on this attitude dies instantly. The idea of buying a stock because you heard a good story on television becomes laughably irresponsible. When you only have 20 chances to secure your entire financial future, each one takes on the weight and gravity it deserves. This was the lesson he was trying to impart to those students. He was trying to save them from a career of what his partner Charlie Munger would later call diversification. The practice of adding more and more investments to a portfolio until the investor is so spread out, they have no idea what they own, and their returns drift inexorably towards a state of permanent, fee-drenched mediocrity. The punch card was the antidote. It was a declaration that in the world of high-stakes capital allocation, you are not rewarded for frequency, you are rewarded for magnitude. The genius of the 20-slot punch card is not just philosophical, it is deeply rooted in the quirks and flaws of human psychology. It is a powerful tool designed to counteract some of our most destructive cognitive biases. The first and most obvious is the paradox of choice. We intuitively believe that more options are better. More cereals in the aisle, more shows on the streaming service, more stocks to choose from. But study after study, most famously by psychologist Barry Schwartz, has shown the opposite to be true. An overabundance of choice leads to anxiety, indecision, and often poorer outcomes. When faced with 100 different mutual funds, the average person is more likely to either make a random, uninformed choice or simply give up and do nothing. Their brain, overwhelmed, defaults to the easiest path. The punch card is a brilliant psychological hack that solves this problem. By artificially constraining your choices to just 20 for a lifetime, it eliminates the paralysis. It forces your brain to switch gears. It moves you out of the fast, intuitive, and often irrational part of your brain that Daniel Kahneman called System 1, and forces you to engage the slow, deliberate, analytical System 2. You can't make a 20 lifetime slots decision on a gut feeling. The stakes are too high. The scarcity of the slots forces a depth of research that would be impossible if you were trying to evaluate hundreds of possibilities. You are no longer just looking for a good idea. You are looking for an absolute, undeniable, table-pounding certainty. The second bias this model attacks is decision fatigue. The human mind has a finite amount of high-quality decision-making energy. The more decisions you make, the worse the quality of those decisions becomes. A typical day trader might make dozens of decisions in a single day, buying and selling on minute fluctuations. By the end of the day, their cognitive resources are depleted. They become more impulsive, more likely to make mistakes, and more susceptible to emotional swings. The punch card investor, by contrast, might make one decision every 2 or 3 years. Their cognitive energy is not wasted on the daily noise. It is conserved and then deployed with immense focused force on the 1 or 2 opportunities that truly matter. They are playing a different game entirely, a game of calculated, decisive strikes rather than a frantic flurry of activity. This mental model also serves as a powerful defense against the siren song of fear of missing out, or FOMO. The modern financial media is an engine designed to generate FOMO. Every day there is a new hot stock, a new sector that's taking off, a new cryptocurrency that's going to the moon. This triggers a primal fear in our brains that others are getting rich while we are being left behind. It's a powerful impulse that leads to terrible investment decisions, causing people to pile into assets at the peak of a bubble, just before it pops. The punch card holder is largely immune to this. When a new fad emerges, their first thought isn't, "How can I get in on this?" It's, "Is this truly one of the 20 best opportunities I will see in my entire life?" The answer is almost always a resounding no. It allows for a calm, detached analysis, while the rest of the world is caught in a frenzy. It gives you the psychological permission to say no 99.9% of the time, knowing that your success depends not on catching every wave, but on catching the one or two tsunamis. It is a system for turning your own psychological flaws into strengths, using a simple constraint to enforce a level of discipline that most people can never achieve on their own. So how do we take this powerful philosophy and turn it into a practical, applied system for our own financial lives? We must build our own punch card blueprint, a concrete process that translates Buffett's analogy into an actionable investment strategy. The first step is to create the punch card itself. This might sound trivial, but the physical or digital act of creating it is a powerful psychological commitment. Buy a piece of thick cardstock and draw 20 circles on it, or create a locked document on your computer with 20 numbered slots. This artifact is your new constitution. It is the visual representation of your commitment to a new way of thinking about capital allocation. Every time you look at it, you will be reminded of the scarcity and importance of your decisions. The second step is to establish your non-negotiable checklist. A slot cannot be punched based on a feeling or a story. It can only be punched if a potential investment survives a brutal, predefined gauntlet of criteria. This checklist is your intellectual filter. It might include questions like, do I understand this business so well that I could explain its competitive advantage to a 10-year-old? Am I confident this business will be more prosperous and dominant in 10 years than it is today? Is the management team both talented and honest, with a track record of acting in the best interests of shareholders? Is the business currently trading at a significant discount to my conservative estimate of its intrinsic value? This checklist should be your own, tailored to your own circle of competence, but it must be rigorous, and it must be written down before you even start looking at opportunities. The third, and perhaps most crucial step in the blueprint, is what we can call the pre-mortem punch. Before you are allowed to punch a hole in your card, you must perform a rigorous pre-mortem. You must sit down and write a detailed one-page essay on exactly how and why this investment will fail. You have to become your own devil's advocate. Argue passionately that the competitive advantage is fragile, that the management is secretly incompetent, that your valuation is wildly optimistic. If you cannot construct a powerful, convincing argument against the investment, it's a sign that you haven't done enough research and are suffering from confirmation bias. This process forces intellectual honesty and helps to inoculate you against falling in love with your own ideas. Only after surviving this intellectual stress test can an idea be considered worthy of a punch. The fourth step is the execution and sizing. When an idea passes all these tests, the punch card model demands a significant allocation of capital. This is not a system for taking a 1 or 2% position. A true punch card opportunity deserves a substantial commitment, perhaps 10, 15, or even 25% of your investment portfolio. This is the part that requires courage, but it's a courage born of deep conviction and exhaustive work, not blind arrogance. The size of the bet reflects the quality of the idea. Finally, there is the punch review. Once a year, you must review your punched slots. But this review is not about checking the stock price. The market is volatile and irrational in the short term. The review is about assessing the quality of your original decision based on the criteria you set out. You must ask, is the business performing as I expected? Has the competitive moat widened or narrowed? Has management acted rationally with the capital they've retained? This process reinforces the idea that you are a business owner, not a stock renter. The price will eventually follow the business results, and your focus must remain squarely on the business, not its fluctuating quotation. This blueprint transforms the punch card from a folksy analogy into a robust, systematic framework for making high-quality, high-conviction decisions, laying the foundation for any serious journey towards financial independence. To truly appreciate the power of this focused approach, we must shine a harsh light on its opposite, the path walked by the 99%. This is the path of the herd, the path of frantic activity and guaranteed mediocrity. It is the path of diversification. The typical investor's portfolio is a reflection of their unfocused mind. They might own a dozen different mutual funds, each of which in turn owns hundreds of different stocks. They have an S&P 500 index fund, an international stock fund, an emerging markets fund, a small-cap value fund, and a handful of individual stocks they picked up along the way, perhaps some Apple, some Tesla, and that one speculative biotech company their cousin recommended. In total, they have fractional ownership in thousands of companies, and they could not tell you the first thing about the business models of 99% of them. They are not investors, they are collectors. They collect ticker symbols like some people collect stamps, hoping that the sheer quantity of their holdings will protect them. This is the great illusion of safety sold by the financial industry. They call it diversification, but Charlie Munger had a more accurate and cynical term, diversification. It's the process of adding more and more assets to a portfolio not because they are great ideas, but simply for the sake of adding them. The result is a portfolio that is so spread out, so diluted, that it is mathematically impossible for it to generate anything other than average returns, minus the fees paid to the managers and advisors for creating this illusion of complexity and safety. This path is driven by a constant, low-grade anxiety. The diversified investor is a slave to the news cycle. When the market is up, they feel a fleeting sense of genius. When the market is down, they are consumed by panic. They are constantly tinkering, rebalancing, selling last year's losers to buy last year's winners, a behavior known as, quote, chasing performance. This constant activity creates a massive drag on their returns. Every transaction incurs costs, both visible, like commissions, and invisible, like the bid-ask spread. More importantly, every sale of a winning position triggers a taxable event, forcing them to give a significant portion of their gains to the government year after year, crippling the magical engine of compounding. The psychological toll is immense. They are perpetually uncertain, because their portfolio is not built on a foundation of knowledge or conviction. It is built on hope and the vague notion that the market always goes up over the long run. They have outsourced their thinking to others, to fund managers, to television pundits, to automated robo-advisors. In doing so, they have abdicated the single most important responsibility in their financial lives: the intelligent allocation of their own capital. The punch card investor, by contrast, lives in a world of serene confidence. They ignore the daily noise because they are not invested in the market. They are invested in a tiny handful of extraordinary businesses that they know inside and out. They welcome market downturns, seeing them not as a source of fear, but as a rare opportunity to potentially punch another slot on their card at an even more attractive price. The path of the 99% is a treadmill of high activity, high fees, high taxes, and high anxiety, all leading to a destination of profound mediocrity. It is the safe, comfortable, and well-trodden path to an average financial outcome. The punch card is the path less traveled, a path that demands discipline, patience, and courage, but one that leads to a completely different destination: true and lasting financial freedom. The difference between these two philosophies isn't just academic, it manifests in the cold, hard numbers on a balance sheet and in the long-term growth of a portfolio. The direct financial connection is where the power of the punch card model becomes undeniable. Let's quantify the impact. Imagine two investors, both starting with a portfolio of $100,000. The first investor, let's call her Diana the Diversifier, follows the conventional wisdom. She builds a portfolio of 50 different stocks with 2% of her capital in each. The second investor, let's call him Charles the Concentrator, follows the 20-slot punch card philosophy. He waits patiently and, after exhaustive research, finds an extraordinary opportunity. He allocates a significant portion, say 25% of his portfolio, or $25,000, to this single idea. Now let's assume that both investors are skilled enough to find a company that, over the next decade, grows tenfold. It's a huge winner, a life-changing stock. For Diana, her 2% position, which started at $2,000, grows to $20,000. It's a fantastic return on that one stock. Her total portfolio grows from $100,000 to $118,000, assuming the other 49 holdings went nowhere. It's a nice gain, but it's not life-altering. Now look at Charles. His 25% position, which started at $25,000, also grows tenfold. It becomes $250,000. His total portfolio grows from $100,000 to $325,000 from that single decision, again assuming the rest of his capital was just sitting in cash. His net worth has more than tripled because of one great idea, executed with conviction. Diana got a nice base hit. Charles hit a grand slam. This is the mathematics of wealth creation. You do not get rich by earning 8% a year on 100 different things. You get rich by earning a spectacular return on a few things. Compounding this over a lifetime, the difference becomes a chasm. The wealth management industry rarely talks about this because it's a terrifying concept for their business model, which is built on gathering assets and charging a percentage fee. It is far easier and safer for them to tell you to own a little bit of everything. That way, no single mistake can be blamed on them, but they also ensure no single success can transform your life. The punch card philosophy is the only way to achieve what is known as a step function increase in your net worth. It's the difference between walking up a gentle slope and taking a quantum leap up a staircase. Furthermore, the financial benefits extend beyond pure returns. The concentrated, long-term investor has a massive tax advantage. By refusing to trade frequently, they defer capital gains taxes for years or even decades. That money, which the active trader would have paid to the IRS, remains in the portfolio, compounding on their behalf. It is a powerful, hidden tailwind that dramatically boosts long-term results. For any business owner or entrepreneur listening, this is the language of capital allocation you already understand. You don't start 10 different businesses and hope one works out. You pour all of your time, energy, and capital into one or two ventures that you believe in, with every fiber of your being. The punch card simply asks you to apply that same successful logic to your investment portfolio. It demands that you treat your investments not as lottery tickets, but as businesses you own, and in doing so, it unlocks a level of financial performance that is simply inaccessible to those who choose the crowded, comfortable path of diversification. The punch card creates the discipline of scarcity, but that discipline is useless without a target. You cannot concentrate your capital with conviction unless you know, with a high degree of certainty, what you are aiming for. This brings us to the second great pillar of the Buffett philosophy, the circle of competence. This is the engine of high conviction. It is the simple, yet profound idea that you don't have to be an expert on every company, or even on most companies. You only have to develop a deep, intimate, and unshakable understanding of a few. Your financial success is not determined by the size of your circle, but by how well you define its boundaries and how disciplined you are about staying within them. A perfect illustration of this principle in action is one of the most important acquisitions in Berkshire Hathaway's history, the purchase of See's Candies in 1972. At the time, Buffett and Munger were being presented with all sorts of complex business deals, aerospace companies, technology firms, intricate financial instruments. But they were drawn to a business that was almost laughably simple, a family-owned chocolate company based in California. See's Candies was not a revolutionary business. It didn't have a patent on some groundbreaking technology. What it had was a powerful, intangible asset, a beloved brand that resided in the minds of its customers. For decades, when a customer in California wanted to buy a box of chocolates for a gift, they didn't think, "Where can I buy some chocolate?" They thought, "I need to go to See's." This mental monopoly created incredible pricing power. The company could raise its prices year after year to cover rising costs, and customers would happily pay because the product was associated with quality, nostalgia, and special occasions. Buffett understood this on a gut level. He didn't need a complex algorithm or a PhD in economics to grasp the business model. He could see its moat. The negotiation for the company was a crucial moment. The C family was asking for $30 million, and Buffett's initial calculation of the company's tangible assets, its factories and inventory, came out to only about $8 million. By the conventional value investing metrics of the day, which focused on buying companies for less than their liquidation value, it looked expensive. But this is where Charlie Munger made one of his most important contributions. He pushed Buffett to evolve his thinking, to understand that it was worth paying a premium for a truly high-quality business with a durable competitive advantage. As Munger famously said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. They ended up paying $25 million. A price that seemed high to many at the time. But Buffett and Munger were operating within their circle of competence. They understood the psychology of the consumer, they understood brand loyalty, and they understood the beautiful economics of a business that could grow without requiring huge amounts of additional capital investment. See's Candies went on to generate over $2 billion in pre-tax profit for Berkshire Hathaway over the subsequent decades, all while requiring very little new capital. It became Berkshire's blueprint for identifying great businesses and the, quote, intellectual candy store that provided the cash to fund countless other investments. Buffett chose See's not because it was exciting or complicated, but because it was simple and understandable. He knew the boundaries of his knowledge, and he had the discipline to play right in the middle of that circle. That is the only place where true, unshakable conviction can be born. The circle of competence is more than a business principle. It's a psychological shield against one of the most dangerous biases an investor can face, the Dunning-Kruger effect. This is a cognitive bias, first identified by psychologists David Dunning and Justin Kruger, in which people with low ability at a task overestimate their ability. Put simply, it's the phenomenon where people are too ignorant to recognize their own ignorance. In the world of investing, the Dunning-Kruger effect is a weapon of mass financial destruction. A person reads a few articles about artificial intelligence and suddenly believes they are qualified to pick the winning AI stock. An engineer at a software company thinks that their expertise in coding translates into an expertise in valuing the entire software industry. This overconfidence leads them to step far outside of what they actually understand, making concentrated bets based on a shallow and fragile base of knowledge. When the story they've told themselves inevitably collides with reality, the financial consequences are devastating. The circle of competence is a deliberate, conscious act of intellectual humility. It is a commitment to being brutally honest with yourself about what you know and, more importantly, what you don't know. Warren Buffett famously quipped, "You don't have to be a rocket scientist." Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Rationality is essential. His genius is not that he knows everything, it's that he knows exactly where the perimeter of his knowledge lies. For decades, he famously avoided technology stocks. It wasn't because he thought technology was a bad investment. It was because he openly admitted he didn't understand it well enough to predict which companies would have a durable competitive advantage in 10 or 20 years. While others were chasing the dot-com bubble in the late 1990s, he was calmly investing in companies that sold bricks, carpets, and insurance. He was ridiculed for being an old-fashioned dinosaur who didn't get it. But when the bubble burst and trillions of dollars of speculative wealth evaporated, his discipline was vindicated. He wasn't smarter than everyone else. He was more rational. He stayed within his circle. This principle also fights against our brain's desire for novelty and excitement. Our minds are drawn to complex, futuristic stories about disruptive technologies and world-changing innovations. We'd rather invest in a gene-editing company we don't understand than a trash-hauling company we do, because the story is more compelling. The circle of competence forces you to invert this. It demands that you find your edge in the boring industries that you genuinely understand through your profession, your hobbies, or your deep, deliberate study. True conviction, The kind required to make a massive bet and hold it through market turmoil, cannot be borrowed. It cannot come from an analyst report or a TV personality. It must be earned through a deep, personal understanding of the business. By forcing yourself to operate only within that circle, you are building a psychological fortress that protects you from the market's manias and your own worst intellectual impulses. Building and maintaining your own circle of competence is an active, ongoing process. It's not a passive state of being. Here is a practical blueprint for defining, operating within, and thoughtfully expanding your own circle. The first step is to conduct a thorough competence audit. Take out a piece of paper and divide it into 3 columns. In the first column, list your professional expertise. What industry have you worked in for years? What processes, customers, and competitive dynamics do you understand better than almost anyone? If you're a doctor, you have a huge head start in understanding healthcare companies. If you're in logistics, you know the transportation and warehousing industry. This is your core competency. In the second column, list your deep, lifelong hobbies and passions. Are you a passionate gamer who understands the video game industry? Are you a car enthusiast who knows the automotive supply chain inside and out? These areas of intense personal interest are often fertile ground for developing a genuine informational edge. In the third column, list the products and services you use every single day and couldn't live without. From the bank you use, to the software on your computer, to the consumer brands you buy without thinking. These are potential starting points for research. This audit gives you a map of your current intellectual territory. The second step is to apply the explain it to a child test. For any company that you believe is within your circle, you must be able to pass this simple test. Can you explain in simple terms exactly how this business makes money and why its competitors can't easily take its customers? If your explanation involves a lot of jargon, complex financial terms, or vague generalities, it's a red flag. It's not in your circle yet. True understanding is marked by the ability to simplify. As Einstein reportedly said, if you can't explain it simply, you don't understand it well enough. The third step is to curate your information diet. Once you know your circle, you must change how you consume information. Stop watching the daily market news on TV. It's designed to create anxiety and encourage trading. Instead, subscribe to the trade journals and industry publications for the specific sectors you've identified. Read the annual reports of the top 5 companies in that industry, not just the one you're interested in. Follow the most respected industry analysts, not the stock-picking gurus. Your goal is to become a genuine expert in a narrow field, to know more about that specific niche than 99% of other investors. The final step is a process for gradual and deliberate expansion. Your circle is not meant to be a permanent prison, but expansion must be approached with caution and discipline. Choose one industry that is adjacent to your current circle. For example, if you're an expert in residential real estate, you might choose to study the commercial real estate or mortgage industries next. Then, commit to a 100-hour deep dive. Before you are allowed to even consider making an investment, you must spend at least 100 hours reading books, reports, and analyses about that new industry. This structured approach prevents you from casually drifting into areas you don't understand and ensures that when you do expand your circle, you do so from a position of strength and genuine knowledge. This blueprint turns the abstract concept of a circle of competence into a tangible, lifelong project in building real financial literacy. The opposite of operating within a well-defined circle of competence is the path of the hot tip chaser. This is the investor whose portfolio is a chaotic graveyard of yesterday's fads and forgotten stories. Their strategy is purely reactive, driven by whatever narrative is loudest at any given moment. Their journey often begins with a piece of advice from a well-meaning but equally uninformed friend or relative. You've got to get into this crypto coin, it's the next Bitcoin. Or, my buddy works at this biotech company and they're about to get FDA approval. It's a sure thing. Lacking any framework for independent analysis, the hot tip chaser is susceptible to these compelling stories. The story is the thesis. They buy the stock, not because they understand the business, its financials, or its competitive landscape, but because they have a fear of missing out on easy money. Their portfolio becomes a reflection of the media hype cycle. In 2020, they might have bought shares in unprofitable work-from-home stocks. In 2021, they piled into meme stocks, NFTs, and speculative SPACs. Today, they're chasing anything with AI in its name. They're constantly jumping from one lily pad to the next, always arriving just as the crowd does, and often just before the smart money begins to cash out. There is no underlying philosophy, no consistent investment strategy. It is pure, unadulterated speculation disguised as investing. The emotional experience of this path is a brutal roller coaster. They experience the gambler's high when one of their tips momentarily pays off, reinforcing their belief that they have a special insight into the market. This temporary success fuels their overconfidence, leading them to take even bigger risks on ideas they understand even less. But this is inevitably followed by the crushing lows when the story falls apart, the hype fades, and the stock price collapses. They are left holding the bag, confused and betrayed, not understanding what went wrong because they never understood the business in the first place. This cycle of hope and despair is not only financially ruinous but also psychologically exhausting. They eventually conclude that investing is just gambling or the market is rigged, because their experience has been exactly that. They were never playing the game of investing, which is the long-term ownership of productive businesses. They were playing a game of musical chairs, and they lacked the one thing that could have protected them: the intellectual humility to admit what they didn't know. The circle of competence investor, by contrast, operates in a state of calm. They don't need hot tips because their ideas are generated from their own deep knowledge base. They don't chase fads because they are focused on the long-term durable economics of the businesses they own. By choosing to play only the games they know they can win, they opt out of the chaotic, wealth-destroying circus that consumes the 99%. The financial advantage of staying within your circle of competence is profound and directly measurable. It is the difference between guessing and knowing. When you operate deep within your circle, your ability to forecast a business's future performance improves dramatically. This has a direct impact on the most critical component of any serious equity research process: calculating a company's intrinsic value. Intrinsic value is the discounted value of the cash that can be taken out of a business during its remaining life. For an investor who doesn't truly understand a business, say a complex pharmaceutical company with a pipeline of drugs in clinical trials, trying to project future cash flows is pure guesswork. They are forced to rely on the projections of Wall Street analysts, who are themselves often just following the herd. The range of possible outcomes is enormous, and their valuation is built on a foundation of sand. But for an investor who has, for example, spent their entire career in consumer packaged goods and is analyzing a company like Coca-Cola, the picture is completely different. They understand the stability of the demand, the power of the brand, the efficiency of the distribution network. They can project future sales, margins, and capital requirements with a much narrower, more confident range of possibilities. This doesn't mean they can predict the future with perfect accuracy, but their estimate of intrinsic value is grounded in a deep, qualitative understanding of the business. This superior valuation ability allows for the creation of a true margin of safety, a concept pioneered by Buffett's mentor, Benjamin Graham. The margin of safety is the difference between the calculated intrinsic value of a business and the price at which it is currently trading on the stock market. A competent investor will only buy when there is a significant discount, creating a cushion against errors in judgment or unforeseen problems. The hot tip chaser has no margin of safety because they have no credible estimate of intrinsic value. The price they pay is arbitrary, based on emotion and hype. For them, the only hope is that someone else will come along and pay an even higher price, the greater fool theory. The competent investor's return comes from the business itself performing over time and the market price eventually converging with the business's intrinsic value. This is a crucial distinction. It is the difference between speculation and investment. Furthermore, a deep understanding of a business allows an investor to act rationally when the stock price is volatile. When the stock of a company you don't understand falls by 30%, it's terrifying. You don't know if it's a temporary market panic or a sign that the business is fundamentally broken. The natural reaction is to sell and cut your losses. But when the stock of a company you know intimately falls by 30% and you have confirmed that the underlying business is still healthy and strong, it is not a threat. It is a gift. It is a rare opportunity to increase your ownership stake in a wonderful business at a bargain price. This ability to act with greed when others are fearful is only possible when your conviction is rooted in competence. It is the ultimate financial connection, a direct line from deep knowledge to superior long-term investment returns. You have now internalized the first two pillars. The punch card has given you the discipline of scarcity, and the circle of competence has provided the engine for high conviction. But there is a third, equally critical element to this wealth-building machine. It is the temperament, the psychological fortitude to do nothing for vast stretches of time. This is the third pillar, the patience of a predator. A concentrated investment strategy is, by its very nature, a game of intense waiting punctuated by moments of decisive action. You must have the discipline to say no to hundreds of good ideas, holding your capital and your precious punch card slots in reserve, waiting for the one truly great idea. It's about having the patience of a lioness on the savannah, lying perfectly still in the tall grass, watching the herd go by, conserving her energy. She doesn't chase every small gazelle that wanders past. She waits, with absolute focus, for the one large, slow-moving wildebeest to stray from the pack. That is the fat pitch. And in investing, as in hunting, that is where the real prize lies. A powerful example of this predatory patience is Buffett's landmark investment in the Washington Post Company in 1973. The early 1970s were a brutal time for the stock market. The Nifty 50 bubble had burst, the Vietnam War was raging, and an oil crisis was crippling the economy. The market was gripped by fear and pessimism, falling by nearly 50% in a 2-year period. It was a time of frantic selling and widespread panic. Most investors were desperately trying to do something: sell stocks, move to cash, find the next safe haven. Buffett, for the most part, did nothing. He sat in his office in Omaha and read. He was doing his homework, studying businesses, waiting. One of the businesses he had been studying for years was the Washington Post. He understood its incredible competitive position. In a city like Washington, D.C., the Post had a virtual monopoly on local news, advertising, and political influence. It was an economic fortress. But the market, in its panic, didn't care. It focused on short-term problems. The company was embroiled in the Watergate scandal, which, while a journalistic triumph, created political uncertainty. The general market malaise dragged down all stocks, good and bad. The stock price of the Washington Post collapsed, falling by more than half. By mid-1973, the market was valuing the entire company at around $80 million. Buffett, having done his homework, knew that this was an absurd price. He estimated that the company's individual assets, its television stations, its Newsweek magazine, its newspaper printing presses, were worth at least $400 million if sold off separately. He could buy the entire company for a price that was a fraction of its easily verifiable private market value. This was not just a good pitch, this was the fat pitch, slow and right over the middle of the plate. And so, after a long period of inactivity, he acted decisively. He began buying shares aggressively, investing over $10 million, a huge sum for his partnership at the time. He had the patience to wait for the perfect moment when a wonderful business met a foolish price. That $10 million investment would grow to be worth over $1 billion in the following decades, becoming one of the cornerstones of Berkshire Hathaway's fortune. It was a testament to the idea that, in investing, you are often paid not for your action, but for your inaction. You are paid for the disciplined patience to wait for the opportunities where you cannot possibly lose over the long term. This ability to wait patiently is a direct counterattack against a deeply ingrained human psychological flaw, the action bias. As a species, we are wired for action. When faced with a problem or a threat, our evolutionary instinct is to do something, anything. This was a valuable survival trait on the African savanna when a rustle in the bushes might be a predator. Inaction could mean death. But in the modern world of investing, this same instinct is a liability. The rustle in the bushes is a down day in the market, a negative news headline, or a stock that isn't moving. Our action bias screams at us to react. Sell the loser, buy the winner, change the strategy. The financial industry is built to exploit this bias. The constant stream of breaking news, the real-time stock tickers, the buy and sell ratings from analysts, it's all designed to make you feel that you need to be constantly active to succeed. But the truth is that for a long-term investor, most of this activity is not just useless, it's counterproductive. Buffett has often said that the ideal holding period for a stock is forever. He has compared investing to being a farmer. A farmer doesn't dig up his seeds every week to see if they're growing. He plants them in fertile soil and then patiently waits for the harvest. The investor who is constantly trading is like the anxious farmer, destroying the very crop he is trying to cultivate. Another powerful psychological force at play is hyperbolic discounting. This is our brain's tendency to prefer smaller, immediate rewards over larger, delayed rewards. We'd rather have $20 today than $100 a year from now. In investing, this manifests as a preference for small, quick trading profits over the massive, life-changing wealth that can only be built through long-term compounding. Day trading and frequent trading provide the immediate gratification of a small win, a little dopamine hit that makes us feel smart and successful. The patience of a predator requires a conscious override of this short-term thinking. It requires the ability to delay gratification on an epic scale, to forego the small, satisfying wins of today in pursuit of the truly transformative gains of tomorrow. It is a form of financial mindfulness, the ability to observe the market's manic urges and your own impulsive reactions without being compelled to act on them. It's the understanding that your greatest advantage as an individual investor is not a faster computer or more information, but a longer time horizon and a superior temperament. By embracing inactivity as your default setting, you starve your cognitive biases of the oxygen they need to thrive, allowing your rational, long-term thinking to guide your decisions. This is perhaps the most difficult skill for any investor to master, as it requires fighting against your own nature, but it is absolutely essential for the successful execution of a concentrated punch-card investment strategy. So how do we cultivate this almost superhuman patience in a world that screams for action? We need an applied mental model, a framework to turn the theory of inactivity into a daily practice. Let's call it the investment sabbatical framework. The first component of this framework is to create no-trade zones. These are predefined periods during which you are programmatically forbidden from making any transaction in your portfolio. A great place to start is the first and last hour of the trading day. This is when market volatility is often at its highest, driven by overnight news and institutional order flows. It is the amateur's hour, a time when emotional decisions are most likely to be made. By simply making it a rule that you do not trade during these times, you protect yourself from your worst impulses. You can expand this concept further, mandating a 48-hour cooling-off period after a major market event or a significant drop in one of your holdings. This enforces a pause, allowing your rational mind to catch up with your initial emotional reaction. The second component is to shift your focus from a buy list to a watch list. Most investors are constantly searching for things to buy. The patient predator is searching for businesses to understand. Your primary task is not to find stocks, but to build a highly curated, deeply researched watch list of 5 to 10 truly exceptional businesses. These are the companies that you would love to own, the ones that meet all the criteria of your non-negotiable checklist. You should do all the work up front. Read the last 10 years of annual reports. Study the competition, build your valuation model. Then, and this is the crucial part, you set a price alert for your fat pitch price. the price at which the business would be trading at a significant margin of safety. And then you do nothing. You go about your life, you read, you learn, you wait. This transforms the investment process from an active hunt into a patient trap. You've already done the work. Now you're just waiting for the market, in its folly, to walk the prize into your snare. The third and final component is what I call the boredom metric. You must learn to rewire your brain's reward system. In most areas of life, excitement and activity are correlated with progress. In long-term investing, the opposite is true. If managing your portfolio feels exciting, if you are constantly checking prices and feeling the thrill of the market's ups and downs, you are doing it wrong. Your goal should be to make your portfolio management as boring as watching paint dry. True success in this domain should feel uneventful. The excitement should come from the initial phase of research, the intellectual thrill of deeply understanding a new business or industry. The actual act of investing, the occasional decisive purchase, should be a calm, logical, and almost anticlimactic event. By embracing boredom as a sign of a sound process, you detach your ego from the market's daily whims and anchor your strategy in the bedrock of patience and discipline. To understand the serene power of this patient approach, we need only look at its chaotic and destructive alternative, the day trader's delusion. This is the path taken by those who believe that the secret to wealth is frenetic activity. The day trader's life is a whirlwind of blinking lights and cascading numbers. They are shackled to their computer screens from the opening bell to the closing bell, their eyes darting between price charts, news feeds, and chat rooms. Their world is one of technical indicators, moving averages, RSI, Bollinger Bands, a complex system of lines and patterns that they believe can predict the market's short-term whims. They're not concerned with the underlying businesses. They're concerned only with the psychology of the crowd, trying to guess what other traders will do in the next few minutes or hours. They celebrate a 1% gain as a work of genius and lament a 2% loss as a cruel twist of fate. This is not investing. It is high-stakes, high-stress pattern recognition, a game where the odds are overwhelmingly stacked against them. The financial friction they face is immense and unavoidable. Every trade they make has a cost. There's the commission paid to the broker. There's the bid-ask spread, the small difference between the buying and selling price, which acts as a tiny tax on every transaction, a tax that adds up to a fortune over thousands of trades. And most punishingly, there are the taxes. Any profit they manage to eke out is a short-term capital gain, taxed at the highest marginal income tax rates. They are running a race against a headwind of costs and taxes that makes long-term success a near impossibility. The psychological toll is even greater. Their lives are a constant state of heightened alert, flooded with the stress hormones cortisol and adrenaline. Their decision-making is clouded by a fog of emotion, greed when they are winning, fear when they are losing, hope when a trade is going against them. They are engaged in a constant battle, not just with the market, but with their own primal instincts. This frenetic activity provides the illusion of control. By constantly clicking buttons and moving capital, they feel like they are in command of their financial destiny. But in reality, they are a cork tossed about on the waves of market noise, reacting to every ripple, mistaking randomness for signal. The patient, long-term investor, the practitioner of strategic inactivity, stands on the shore, observing this chaos with a detached calm. They understand that real control comes not from constant action, but from the disciplined refusal to act until the odds are overwhelmingly in their favor. The day trader is playing checkers in a hurricane. The punch card investor is playing chess in a library, and in the long run, there is no contest as to who will win. The direct financial connection between patience and wealth is one of the most powerful but least understood forces in finance. It can be summarized in two words: compounding and taxes. Let's run the numbers on two investors, both of whom are skilled enough to generate a 15% annual pre-tax return. Investor A is the active trader. He trades frequently, realizing his gains each year. Investor B is the patient concentrator. He finds a few great companies and holds them for the long term, realizing no gains along the way. Both start with $100,000. In year one, both earn $15,000. Investor A, the trader, sells his winners and pays short-term capital gains tax. Let's assume a combined federal and state rate of 40%. He pays $6,000 in tax, and his portfolio grows to $109,000. Investor B, the patient holder, does nothing. His portfolio grows to $115,000. The $15,000 gain is unrealized, so no tax is due. In year one, the difference seems small, but this is the insidious magic of compounding. In year two, Investor A starts with $109,000. A 15% return is $16,350. After paying his 40% tax, his portfolio grows to $121,810. Investor B started with $115,000. His 15% return is $17,250. His portfolio grows to $132,250. He still pays no tax. The gap is widening. Let's fast forward 30 years. Investor A, the active trader, by constantly giving away 40% of his profits to the government, would see his initial $100,000 grow to approximately $1.1 million. A respectable sum, but Investor B, the patient concentrator, by simply allowing his capital to compound without the constant drag of taxes, would see his initial $100,000 grow to over $6.6 million. That is a difference of $5.5 million. It is a life-altering, dynasty-building chasm in financial outcomes, created by a single variable, the discipline of inactivity. This is a concept that professional wealth management firms understand intimately. Tax efficiency is one of the greatest sources of alpha or outperformance that they can provide. By refusing to trade, the patient investor is essentially giving themselves an interest-free loan from the government on their deferred tax liability. That money, which would have been sent to Washington, is instead working and compounding for them year after year. Patience, therefore, is not a passive virtue in investing. It is an active and incredibly potent financial tool. It is a multi-million-dollar decision, disguised as the simple choice to do nothing. When you understand this math, you realize that every unnecessary trade is an act of financial self-sabotage, and every year you can hold a great business without selling is another powerful gust of wind in the sails of your long-term compounding machine. We have now established the what, the where, and the when of this strategy. The punch card dictates what we do, make very few, high-conviction bets. The circle of competence dictates where we do it, only in areas we deeply understand. And the principle of patience dictates when we do it, only when a truly extraordinary opportunity presents itself. But there is a fourth pillar that underpins all of these. It is a fundamental shift in identity, from a speculator of stocks to a proprietor of businesses. This is the fourth pillar, the owner's mindset. A stock is not just a little piece of paper or a blinking symbol on a screen. It is a fractional ownership stake in a living, breathing business. Adopting this mindset changes everything about how you analyze, value, and behave towards your investments. You stop asking, where is the stock price going to go? And you start asking, how is the underlying business performing? This shift is the ultimate antidote to the market's short-term madness. Perhaps the greatest story illustrating this mindset is Buffett's masterstroke investment in American Express during the Salad Oil scandal of 1963. American Express was, at the time, a blue-chip company, primarily known for its traveler's checks and credit card businesses. One of its smaller divisions, however, was in warehousing, where it would issue loans against a company's inventory. One of its largest clients was the Allied Crude Vegetable Oil Company. The problem was that the company's founder was a con artist. He had filled giant vats with water and topped them with a few feet of salad oil. He used this fraudulent inventory to secure massive loans from American Express and others. When the fraud was discovered, Allied went bankrupt, and American Express was on the hook for what was then a catastrophic sum of $60 million. Wall Street panicked. The story was horrific, and investors, behaving like speculators, dumped the stock in droves. They saw only the headline, the scandal, the potential for bankruptcy. The stock price was cut in half in a matter of months. But Warren Buffett, then a young, relatively unknown fund manager in Omaha, did something different. He didn't look at the stock chart. He started thinking like a business owner. He asked a simple question. Has this scandal permanently damaged the core, profitable businesses of American Express, the traveler's checks, and the credit cards? To answer this, he didn't read analyst reports. He engaged in what he called scuttlebutt. He went out into the real world. He visited restaurants and banks. He talked to merchants. He talked to customers. He observed their behavior. And what he saw was that people were still using the traveler's checks. Businesses were still proudly displaying the American Express Accepted Here signs. The core franchise, the powerful brand that lived in the minds of millions, was completely unharmed by the scandal in a peripheral division. The market was confusing a temporary, survivable wound with a fatal blow. He concluded that the fundamental earning power of the real American Express business was intact, and so, with the conviction of an owner who had done his homework, he invested 40% of his entire partnership's capital into the stock. It was a massive, concentrated bet. Over the next few years, as the company recovered and the salad oil scandal faded from memory, the stock price soared. Buffett's partnerships made a fortune, and the legend of his analytical prowess began to grow. This was not a stock-picking victory. It was a business analysis victory. He won because he ignored the ticker symbol and focused on the fundamental reality of the business. That is the essence and the power of the owner's mindset. The shift from a speculator's mindset to an owner's mindset is a powerful psychological maneuver that neutralizes several debilitating cognitive biases. The most prominent is the affect heuristic. This is our tendency to let our emotions, our affect, drive our decisions. When we hear a scary news story like the salad oil scandal, our brain generates a feeling of fear and disgust. The speculator, guided by this feeling, hits the sell button. Their decision is a direct response to their emotional state. The owner's mindset forces a wedge between the emotional trigger and the decision-making process. It engages our analytical brain, asking it to evaluate the situation from the perspective of a rational business proprietor. The question changes from, "How do I feel about this news?" to, "How does this news concretely impact the long-term cash-generating ability of this enterprise?" This shift from feeling to analysis is the bedrock of rational investing. Another critical bias that the owner's mindset helps to overcome is myopic loss aversion. This is the well-documented phenomenon that humans feel the pain of a loss approximately twice as powerfully as they feel the pleasure of an equivalent gain. For a stock speculator, a 20% drop in a stock's price is experienced as a painful, immediate loss. Their focus is myopic. It is narrowly fixed on the short-term price fluctuation. This pain often triggers a panicked sale as they try to stop the emotional bleeding. The business owner, however, sees the world differently. If they know the business is sound, a 20% drop in its stock market quotation is not a loss, it's an opportunity. The business they co-own just went on sale. They are less concerned with the myopic daily price swings and more focused on the long-term value creation of the business itself. By identifying as an owner, you psychologically insulate yourself from the market's manic-depressive behavior. You are no longer a passenger on Mr. Market's emotional roller coaster. You are the calm, detached observer, willing to transact with him only when his mood swings to your advantage, offering to sell you his businesses at prices of deep despair or buy them from you at prices of manic euphoria. This mental reframing is not just a semantic trick, it fundamentally alters your perception of risk and opportunity. It provides the emotional stability required to hold a concentrated position through the inevitable periods of market volatility. Without the owner's mindset, the courage required for concentration is impossible to sustain. It is the psychological anchor in the stormy seas of the stock market. To truly cultivate an owner's mindset, you need more than just a change in attitude. You need a change in process. You need a practical blueprint that forces you to behave like a business owner, not a stock trader. Let's call it the CEO for a day protocol. The first step in this protocol is to write the unstock report. Before you are ever allowed to buy a single share of a company, you must write a 1 to 2 page memo, as if you were the incoming CEO taking over the business. This memo is forbidden from mentioning the stock price or any market-related metric. It must answer 4 questions in plain language. First, how exactly does this business make money? What are its key products or services, and who are its primary customers? Second, what is this company's single most important competitive advantage, its economic moat? Why do customers choose this company over its rivals, and why will they continue to do so for the next 10 years? Third, what are the top 3 realistic risks to this business's future prosperity? Not stock market risks, but business risks, changing consumer tastes, new technology, formidable competitors. Fourth, if you were CEO, what would be your top priorities for allocating the company's capital over the next 5 years? Should it be reinvesting in the core business, acquiring competitors, paying down debt, or returning cash to shareholders via dividends and buybacks? This exercise forces you to think strategically about the business as an ongoing enterprise, and is the ultimate test of your understanding. If you cannot write this memo, you have no business owning the stock. The second step is a simple but powerful command: read the damn annual report. Specifically, the 10K, which is the detailed report companies must file with the SEC each year. The vast majority of investors never touch this document. They get their information from filtered news articles and analyst summaries. This is a huge mistake. You must learn to read the 10K not as a stock picker looking for a catalyst, but as a business owner looking for insight. Skip the glossy marketing photos and go straight to the management's discussion and analysis section, where leadership is forced to explain the business's results in their own words. Read the risk factors section with a paranoid eye. And most importantly, learn to read the footnotes to the financial statements, which is where the company often buries the most important details. Reading the 10K from cover to cover is the single best way to get an unfiltered view of the business. The third and final step is to embrace the scuttlebutt method, a term popularized by the legendary investor Philip Fisher and practiced religiously by Buffett. This is the art of doing your own primary, on-the-ground research. If you're analyzing a retail company, go to its stores, observe the customers, talk to the employees, buy the product. If you're analyzing a software company, sign up for a free trial. Read user reviews on forums like Reddit. Try to understand what its customers love and hate about it. This qualitative research provides a texture and depth of understanding that you can never get from a spreadsheet alone. It turns the abstract numbers of a financial statement into a tangible, real-world reality. By following this 3-part protocol, you are forcing yourself to go beyond the ticker symbol and engage with the business on the level of an owner, building the deep, qualitative conviction necessary for long-term success. The antithesis of the owner's mindset is the path of the price worshiper. This individual's entire analytical framework, their entire emotional state, is dictated by one thing and one thing only: the last traded price of the stock. For the price worshiper, the stock price is not a reflection of the business's value. The stock price is the value. Their logic is circular and self-referential. If the stock price is going up, it must be a good company, and therefore a good investment. If the stock price is going down, it must be a bad company and a failing investment. They have completely surrendered their independent judgment to the whims of the market. They are obsessed with charts and technical analysis, seeing profound meaning in patterns like head and shoulders tops or golden crosses. They believe that the past movements of a stock's price hold the secret to its future, without any regard for the underlying business fundamentals. This makes them the perfect embodiment of what Benjamin Graham called Mr. Market. Graham imagined the market as a manic depressive business partner who shows up every day and offers to either buy your shares or sell you his, at a wildly different price depending on his mood. Some days he is euphoric and will offer to buy your shares at a ridiculously high price. Other days he is despondent and will offer to sell you his shares at an absurdly low price. The price worshiper takes Mr. Market's mood swings seriously. When Mr. Market is euphoric and prices are high, they become greedy and buy, convinced the trend will continue forever. When Mr. Market is despondent and prices are low, they become fearful and sell, crystallizing their losses and vowing never to invest again. They are a puppet, and Mr. Market is pulling the strings. The business owner, by contrast, views Mr. Market as a useful but emotionally unstable servant. They are happy to ignore his daily quotations, knowing that they have little to do with the true, long-term value of their enterprise. They use Mr. Market, but they are not used by him. They are willing to sell to him when he is in a state of wild optimism, and buy from him when he is in the depths of pessimism. The price worshipper's approach is a recipe for financial disaster, a guaranteed formula for buying high and selling low. They are perpetually reacting, perpetually chasing, perpetually on the wrong side of the emotional tide. By mistaking the shadow on the wall, the stock price, for the real object, the business, they condemn themselves to a lifetime of poor decisions and frustrating results. The financial manifestation of the owner's mindset is a concept that Buffett frequently discusses: look-through earnings. This is a powerful mental model that completely reframes how an investor views their portfolio and its performance. A typical investor looks at their brokerage statement and sees a list of stock positions and their current market values. Their sense of success or failure is tied to the daily fluctuations of those market values. Buffett doesn't see his portfolio that way. When he looks at Berkshire Hathaway's massive holding in Apple, he doesn't just see billions of dollars of stock. He sees Berkshire's pro-rata share of Apple's underlying annual earnings. Berkshire owns roughly 5.6% of Apple. In a year where Apple earns, say, $100 billion, Buffett mentally accounts for $5.6 billion of those earnings as belonging to Berkshire. This is his look-through earning. He is looking through the stock certificate to the fundamental economic engine of the business itself. This has a profound impact on how he interprets market volatility. If the price of Apple stock falls by 20% in a given year, the typical investor sees a massive loss on their statement and feels poorer. Buffett, if he believes the long-term earning power of Apple's business is still intact or even growing, sees something entirely different. He sees that his share of the underlying earnings has not changed, but the price to buy more of those earnings has just gotten 20% cheaper. The falling stock price makes him feel richer, not poorer, because it represents an opportunity to increase his claim on that future stream of earnings at a more attractive price. This mindset is the ultimate source of emotional stability. It decouples your sense of financial well-being from the irrational, short-term whims of the stock market and anchors it to the tangible, long-term reality of business performance. For your own portfolio, this means you should perform a simple calculation. For each of your holdings, take the company's annual earnings per share and multiply it by the number of shares you own. This is your personal look-through earning for that business. Your goal as an owner is not to see the stock price go up every day, but to see that underlying earnings figure grow consistently over the years. If you can do that, the stock price will eventually, inevitably, follow. This is the ultimate financial connection for the business owner. It is the accounting of a proprietor, not the scorecard of a speculator. It's how you learn to ignore the noise and focus on the signal, a practice that is absolutely essential for executing a concentrated, long-term investment strategy. We have arrived at the final and perhaps most challenging pillar. It requires us to fuse the discipline of the punch card, the knowledge of the circle of competence, the temperament of the patient predator, and the identity of the business owner. It requires us to take all of these elements and act upon them with decisive force. This is the fifth pillar, the courage of concentration. Once you have done the work, once you have waited for the fat pitch right in the middle of your circle of competence, the philosophy demands that you do not just take a small, timid swing. It demands that you swing for the fences. True wealth is not built by spreading your capital thinly across many good ideas. It is built by concentrating it with immense force into a tiny number of truly great ideas. This is where conviction meets capital, and it is the step that separates the master from the amateur. The quintessential example of this courage is Buffett's monumental investment in the Coca-Cola Company in 1988. Following the Black Monday market crash of October 1987, fear still lingered in the air. But Buffett saw an opportunity of a lifetime. He had been a lifelong consumer of Coke, but he began to study it with the intensity of a business analyst. He saw a company with a simple, understandable product. He saw a brand that was not just a brand, but a global icon, embedded in the very fabric of human culture. He traveled, and he saw that while Coke was ubiquitous in the United States, its penetration in many parts of the world was still tiny, giving it a massive runway for future growth. He saw a business that was incredibly profitable, a syrup-in-the-water model that required very little capital to expand. It was a royalty on the thirst of the world. By 1988, he concluded that Coca-Cola was one of the best businesses on the planet, and the lingering post-crash pessimism meant its stock was trading at a reasonable, if not dirt-cheap, price. He didn't just dip a toe in the water, he didn't buy a small starter position. Over a period of several months, he instructed Berkshire Hathaway to buy and keep buying until they had invested over $1 billion into Coca-Cola stock. At the time, this was a staggering sum, making it by far the largest single holding in Berkshire's portfolio. Many on Wall Street were aghast. They saw it as a reckless, overly concentrated bet on a mature company. They accused Buffett of violating the sacred rule of diversification. But Buffett wasn't gambling. His courage was not the product of arrogance or recklessness. It was the natural byproduct of supreme conviction, a conviction that had been earned through hundreds of hours of research and a lifetime of understanding consumer psychology. He knew the business better than the analysts who criticized him. That $1 billion investment in Coca-Cola would become one of the most successful in history, growing more than tenfold over the following decade and showering Berkshire with an ever-increasing stream of dividends. It was the ultimate demonstration of the courage of concentration, the final, decisive act in a long process of disciplined, patient, and intelligent work. Making a concentrated bet requires an investor to overcome some of the most powerful and deeply human psychological biases. The first is ambiguity aversion. Our brains have a natural preference for known risks over unknown risks. We would rather choose a situation with a 50% chance of a known outcome than a situation with an unknown probability of a better outcome. Diversification feels safe because the risk feels known and contained. If you own 100 stocks, the failure of any one company is a small, predictable event. Concentration, on the other hand, introduces a level of ambiguity that our brains find deeply uncomfortable. A 25% position in a single company means your fortune is tied to the fate of that one enterprise. The outcome feels more binary, more uncertain, and therefore more frightening, even if the rational analysis suggests it's a superior bet. The second, and even more powerful bias, is regret aversion. Humans are wired to make decisions in a way that minimizes the potential for future regret. The pain of a bad outcome that results from an unconventional decision is felt far more acutely than the pain of a bad outcome from a conventional one. If you diversify your portfolio like everyone else, and you get average returns, you feel no regret. You did the right thing. But if you make a huge, concentrated bet and it goes wrong, the feeling of regret is crushing. You will be second-guessing yourself for years. Why did I have to be a hero? Why didn't I just do what everyone else was doing? This fear of unconventional failure is a psychological prison that keeps most investors trapped in the safety of the herd. Diversification is the ultimate defense against regret. It is a preemptive apology for potential failure. Concentration requires you to stare the possibility of spectacular public failure right in the face and act anyway. This is why true conviction is so rare and so valuable. It's not just an intellectual belief. It is the emotional fortitude to stand apart from the crowd, to accept the risk of being wrong in a big way because you have done the work to believe, on a rational level, that the odds of being right in an even bigger way are overwhelmingly in your favor. It requires you to silence the primal screams of your own brain that are begging you to seek the comfort and safety of conformity. To make such high-stakes decisions rationally, we need a tool to move beyond gut feel and quantify our conviction. We need an applied mental model for position sizing. Let's call it the conviction scorecard. This is a simple personal rating system that you apply to any potential investment before times you decide how much capital to allocate. The scorecard has 3 key components, each rated on a scale of 1 to 10. The first is the moat durability score. Based on your research, how confident are you that this business's primary competitive advantage will be intact or even stronger 20 years from now? A score of 1 would be a company in a rapidly changing industry with no clear moat. A 10 would be a company like Coca-Cola in 1988, with a timeless brand and a dominant distribution network. Be brutally honest in this assessment. The second component is the management integrity score. How much do you trust the leadership team of this company? Have they demonstrated a history of making intelligent capital allocation decisions? Do they communicate with shareholders in a transparent and honest way? Do their incentives align with yours as a long-term owner? A 1 would be a promotional CEO with a history of value destruction. A 10 would be a founder-led company where the CEO has a massive personal stake and a long track record of treating shareholders like partners. The third component is the valuation certainty score. This measures your margin of safety. How significant is the discount between the current market price and your conservative estimate of the business's intrinsic value? A 1 would be a stock trading at or above your estimate of its value. A 10 would be a situation like the Washington Post in 1973, where the stock was trading for 20 cents on the dollar. Once you have scored a potential investment on these 3 axes, you add up the scores. This total out of 30 becomes your guide for position sizing. This is not a rigid mathematical formula, but a rational framework for executive decision-making. You can create your own position sizing matrix. For example, a total score of 27 to 30 represents a rare fat pitch opportunity. This justifies a major punch on your card and a significant position size, perhaps 20 to 25% of your portfolio. A score of 22 to 26 is a very strong idea, worthy of a 10 to 15% position. A score below 22, no matter how exciting the story, is a pass. It's a good idea, but not a great one, and therefore not worthy of one of your 20 precious slots. This scorecard forces discipline and consistency into your capital allocation process. It prevents you from getting carried away by a single factor, like a cheap valuation on a poorly run business. And it provides a rational, defensible basis for taking the courageous step of concentration when the stars truly align. The ultimate antithesis to the courage of concentration is not just random diversification. It is the modern dogma of passive index fund investing, when adopted by those who claim to be serious students of business and finance. Let me be clear. For the vast majority of people who have no interest in analyzing businesses, a low-cost S&P 500 index fund is the best possible investment they can make. It is a sensible, low-effort way to participate in the long-term growth of the American economy. But for the person watching this, for the entrepreneur, the business owner, the aspiring capital allocator, the index fund represents something different. It represents an intellectual surrender. It is the explicit statement that I cannot or will not do the work required to beat the average. It is what Buffett calls, quote, a protection against ignorance. But for the student of business, it becomes a willing embrace of that ignorance. It is the path of accepting mediocrity from the very outset. It is a form of financial nihilism that says the game is too hard to win, so the best you can do is aim for not losing. The dogma of index funds, when preached as the only rational path, tells you that it is impossible to identify great businesses run by great managers at attractive prices. It tells you that the efforts of Warren Buffett, Charlie Munger, and other great capital allocators were just luck. It tells you that deep equity research is a waste of time. For the person who has the ability and the ambition to play the game at a higher level, defaulting to an index fund is an abdication of their potential. The courage of concentration is the belief that you still can win. It's the belief that through hard work, discipline, and patience, you can identify those few truly exceptional enterprises, and that it is rational to bet heavily on them when you do. It's an embrace of the American spirit of entrepreneurship and intelligent risk-taking, applied to the world of public markets. It is the rejection of the idea that average is good enough. It is the final, necessary step for those who are not content to simply ride the market, but who seek to harness its power to build something truly extraordinary. The direct financial connection of this final pillar is the most crucial of all. It is the redefinition of risk itself. The entire edifice of modern financial theory is built on a flawed definition of risk. It defines risk as, quote, beta, which is simply a measure of a stock's past volatility relative to the overall market. A stock that swings up and down more than the S&P 500 is considered riskier, and a stock that is less volatile is considered safer. This academic definition is, in the real world, complete nonsense. Warren Buffett has a much better definition. For him, risk is not volatility. Risk is the permanent loss of capital. Let's explore this. Imagine two scenarios. In scenario 1, you buy shares in a wonderful dominant business with a strong balance sheet and growing earnings, but you buy it during a market panic when the price is highly volatile. According to Wall Street, this is a high-risk investment because of its high beta. In scenario 2, you buy shares in a mediocre, heavily indebted company in a declining industry, but you buy it during a calm period when its stock price isn't moving much. According to Wall Street, this is a low-risk investment. This is clearly insane. The volatile stock of the wonderful business is far less risky in any meaningful sense than the stable stock of the terrible business. The chance of a permanent capital loss in the first scenario is very low, while in the second scenario it is very high. A concentrated portfolio of a few wonderful businesses will almost certainly be more volatile than a diversified index fund. There will be periods where it underperforms the market dramatically. Its beta will be high. But if the businesses have been chosen correctly, the long-term risk of a permanent capital loss is far, far lower. True risk management in portfolio management does not come from spreading your money across hundreds of companies you don't understand. That is a management of ignorance. True risk management comes from a deep, intimate knowledge of the few businesses you do own. It comes from competence. As Buffett famously said, risk comes from not knowing what you're doing. The courage of concentration is therefore not an act of reckless risk-taking. It is the ultimate act of risk reduction. It is the final expression of a philosophy that equates knowledge with safety and ignorance with risk. It is the understanding that the only way to build true, lasting financial independence is to move beyond the flawed, academic definitions of the herd and to place your bets not on the fickle whims of the market, but on the enduring power of great businesses. You have just absorbed a framework that is diametrically opposed to almost everything modern finance teaches. You've learned that the path to extraordinary wealth isn't paved with hundreds of small, timid bets, but with a few, massive, high-conviction decisions. You now possess the mental model of the 20-slot punch card, a tool for discipline, clarity, and immense financial power. But this tool, as powerful as it is, operates within a larger ecosystem of thought. The punch card tells you how many bets to make, but it doesn't, by itself, tell you which bets to make. It is the focusing lens, but it needs a light source. That light source is the ability to unerringly identify what Buffett calls the inevitable. Businesses so powerful, they are virtually guaranteed to win over the long term. Understanding the punch card without understanding the criteria for the businesses that deserve a punch is like owning a state-of-the-art rifle with no ammunition. The critical next step, the missing link in this chain of reasoning, is mastering the framework for identifying these invincible businesses. The video that is now appearing on your screen is designed to be that next piece of the map. It delves into the specific, tangible qualities that separate a good business from a truly great one. You have already demonstrated that you are not content with average returns or conventional wisdom. You've invested this time to join the 1%. Don't stop now. The journey of the serious capital allocator is a continuous process of assembling a complete mental arsenal. Complete your arsenal. The next law of wealth is waiting for you. Click and continue your ascent.